Is your job safe? Is your 401k safe? The 2008 crisis was built on bad mortgages. The next one is built on bad policy. Today we connect the dots. Why the coming 2025-2026 crash will be worse than 1929 and 2008 combined, and exactly what you need to do to protect your wealth. Let's start with the mistakes history is screaming at us. We're standing in an economic hall of mirrors. Everywhere you look, distorted versions of past crises are staring back. But this time, the reflections are overlapping, creating a monster we've never had to face. The people running our economy are making the same mistakes our grandparents saw, but they're doing it with more debt, more complexity, and way less room to maneuver. To see where we're headed, you have to understand the two historical echoes that are screaming at us right now. The trade war machine of the 1920s is back online. Let's start with the ghost of 1929. Most people think the Great Depression started with the stock market crash, but that was just the trigger. What turned a bad recession into a decade-long global catastrophe was a disastrous policy error, the Smoot-Hawley Tariff Act of 1930. The idea was simple, even seductive: protect American jobs by making foreign stuff more expensive. The reality: it launched a global trade war, choked off international commerce, and vaporized millions of jobs. Now listen to the echo today. In 2025, the United States has adopted its most aggressive trade posture in generations. We're not talking small tweaks. We've seen sweeping tariffs enacted under various authorities. As of mid-2025, Section 232 tariffs on steel and aluminum were increased to 50% for most countries. On top of that, a 25% tariff was placed on imported automobiles and many auto parts. There was even a brief period in April 2025 where retaliatory tariffs with China spiraled, with the US rate hitting a shocking 125% on many goods before being temporarily negotiated down. While some deals have been made, the trend is clear. The weighted average tariff rate on US imports has surged, creating a massive new tax on American consumers and businesses. The official story is that this is about protecting American jobs. But that ignores the reality of a 21st century globalized economy. A tariff on steel doesn't just hit a foreign company. It drives up costs for every American manufacturer that uses steel, from car makers to appliance producers. These aren't just numbers on a page. They're making American manufacturing fundamentally uncompetitive. The Congressional Budget Office, CBO, in its September 2025 analysis, directly stated that higher tariffs are putting upward pressure on costs, which in turn fuels inflation. It's a self-inflicted wound. We are deliberately making it more expensive to produce and buy things, all in the name of economic patriotism. This is the exact same logic that led to the breadlines of the 1930s. We're not just flirting with the ghost of Smoot-Hawley, we've invited it in for dinner. The debt bomb of 2008 is ticking louder. Now let's talk about the more recent ghost, the one that still haunts millions, the 2008 global financial crisis. What was at the core of 2008? Debt. Specifically household debt, all wrapped up in complex financial products no one really understood. It was a crisis of leverage, built on the fantasy that housing prices only go up. When they fell, the whole system came crashing down. Today that debt bomb hasn't been defused. It's been rebuilt, made bigger, and spread to every corner of the American economy. Let's start with your neighbor. As of the third quarter of 2025, total U.S. household debt hit a mind-numbing record high of $18.59 trillion. Let's break that down. Mortgage debt now stands at $13.07 trillion. Auto loan debt is at a record $1.66 trillion. Credit card debt has blown past $1.23 trillion, and student loan debt is a staggering $1.65 trillion. In 2008, the poison was mostly subprime mortgages. Today, it's everywhere. We are at record debt levels in almost every category. To make things worse, the cost of paying for this debt has skyrocketed. The Federal Reserve, in its war on inflation, jacked up interest rates at a historic pace. And while they have recently started to make small cuts, borrowing costs remain painfully high. This is not the zero-interest rate world that allowed the post-2008 economy to limp along. For millions of families, the situation is already critical. Delinquency rates are the canary in the coal mine. According to the New York Fed, Transitions into serious delinquency for debt like student loans are on the rise. A clear signal that the pressure is becoming too much to bear. But the household debt bomb is just one part of this. It's sitting on top of an even bigger mountain of government debt. As of late 2025, the U.S. national debt has crossed the staggering threshold of $38 trillion. This number is so huge it's hard to grasp, so let's put it in context. It took this country from 1776 until early 2024 to rack up $34 trillion in debt. We've added the last few trillion at a breathtaking speed, and the cost of this debt is becoming crippling. The interest payments alone are now one of the fastest growing parts of the federal budget. In 2008, the U.S. government could slash interest rates and pump trillions into the economy to bail everyone out. Today, our ability to do that is severely limited. With a national debt of $38 trillion and interest rates still well above zero, our hands are tied. The government's credit card is nearly maxed out, just as the family's credit cards are hitting their limits. This is the setup. We have the trade war dynamics of 1929 colliding with the debt crisis dynamics of 2008. Either one of these would be enough to cause a nasty recession. But what happens when you mix them? And what about the new factors that make this time truly different and so much more dangerous? That's what the establishment is missing. Why this time is different and worse. The mainstream story from institutions like the CBO is one of a soft landing or a modest slowdown. They see GDP growth slowing to around 1.4% in 2025, with unemployment rising to a manageable 4.5%. They see the storm clouds, but they're telling you it's just a passing shower. They are completely failing to grasp how these historical echoes are being amplified by new, destabilizing forces. This isn't just 1929 plus 2008. This is a new, more terrifying equation. Let's look at the three new variables that could turn a recession into a system-wide meltdown. The deliberate contraction of government. In every major downturn in modern history, the government has acted as a backstop. When the private sector lays people off, the public sector usually stays stable or even grows, acting as a shock absorber. It's basic stuff. Today, we're witnessing a dangerous experiment. The simultaneous contraction of both the private and public sectors. Businesses are already starting to cut jobs due to rising tariff costs and slowing demand. In fact, layoff announcements in October 2025 surged 175% compared to the previous year, hitting the highest level for that month in over 2 decades. Meanwhile, the government is pouring gasoline on the fire. A reduction of the public sector workforce is already underway. Federal government employment has declined by 97,000 jobs since its peak in January 2025. This isn't just a side effect of a recession. There are proposals for deep, deliberate cuts to shrink the size of government at the worst possible time. It's like firing the firefighters while the wildfire is spreading. This is made worse by another policy, the systemic weakening of our tax enforcement. There are active political proposals to dramatically slash the IRS budget. This isn't just about politics. The fiscal consequences are catastrophic. These cuts could lead to hundreds of billions in lost tax revenue, mostly from wealthy individuals and corporations who are experts at dodging taxes. This goes beyond the budget deficit. This is about a crisis of confidence. When a country can no longer effectively collect the taxes it's owed, it sends a signal to the world that its financial house is a mess. Global investors, who hold trillions of our $38 trillion national debt, are watching. They see a country with exploding debt and a shrinking will to even collect its own revenue. This is how a sovereign debt crisis starts. The stagflation nightmare comes true. The word stagflation terrifies economists. It's the toxic mix of economic stagnation, high unemployment and no growth, and high inflation. It's the worst of all worlds, and it's exactly what our current policies are creating. Think about the forces at play. First, inflation. The aggressive tariffs are a direct tax on everything we buy, pushing prices up. Spikes in energy prices, with oil having hovered in the $90 range, increase costs across the board. The CBO's own forecasts from September 2025 project that inflation will rise to 3.1% in 2025 because of these tariff pressures. Second, stagnation. The very same tariffs that fuel inflation are also wrecking the economy by messing up supply chains. The massive private and public sector layoffs are a direct hit to economic growth, killing consumer demand. GDP growth is already forecast to slow significantly in 2025. This creates an impossible trap for the Federal Reserve. And this is the key difference from past crises. In the 1930s, the answer was to print money. In 2008, inflation was low, so the Fed could slash rates to zero and flood the system with cash. Today, the Fed is trapped. If they raise interest rates to fight the inflation our own policies are creating, they will absolutely crush the economy. But if they cut rates aggressively to stop the free fall, they risk pouring gasoline on the inflationary fire. We're already seeing them walk this tightrope. The Fed made small rate cuts in September and October of 2025, bringing the target range down to 3.75% These weren't confident moves. They were the nervous actions of an institution that sees unemployment rising but inflation staying stubborn and knows it has no good options left. Stagflation isn't a fringe theory anymore. It is the central risk of the next 24 months. The fragile global system. No one is coming to the rescue. The final, and maybe most overlooked factor, is the state of the rest of the world. In 2008, when the US and Europe were melting down, the world had a powerful growth engine that helped pull it from the brink: China. China unleashed a massive stimulus package that fueled global demand and acted as a shock absorber for the world economy. Today, there is no savior. The global system is more fragile and fragmented than at any time in recent memory. China, the hero of 2008, is now wrestling with its own slow-motion economic crisis, including a severe real estate downturn and deflationary pressures. Far from being a source of global growth, China is now a potential source of global risk. Europe is dealing with geopolitical instability and its own sluggish growth. Emerging markets are being crushed by the strong dollar and high interest rates. Global growth is slowing everywhere. Forecasts from the IMF show a deceleration across most major economies. The world of 2025 is not the world of 2008. There is no single country ready to pull the rest of the world out of a nosedive. Instead, we have synchronized weakness. The United States isn't an isolated island. We're the biggest ship in a global convoy that is sailing directly into a hurricane, and all the other ships are already taking on water. This is the perfect storm. The trade war of the 1920s, the debt crisis of the 2000s, and now, the terrifying new accelerants of a government contraction, a stagflationary trap, and a fragile, leaderless global system. A blueprint for personal survival hearing. All of this can feel overwhelming, and that's natural. But the goal here isn't to spread fear. It's to replace fear with knowledge and a plan. While the global economic system may be heading for a cliff, that doesn't mean you have to go over it too. The coming crisis, like all crises, will also be a massive transfer of wealth. It will move from the unprepared to the prepared, from those who are leveraged and distracted to those who are liquid and focused. What follows is not financial advice, but a framework for building your personal financial fortress. This is how you can survive what's coming and potentially emerge stronger. Principle 1. Financial fortification. Build your ark. Before you can think about opportunity, you have to ensure your survival. This is the time for radical financial defense. The party's over, the lights are on, and you need to make sure you have a safe ride home. First, de-risking and deleveraging. The era of easy money, where speculative bets paid off, is over. This is the time to critically look at every single thing you own. Ask yourself, is this a productive asset that generates cash, or is it a bet that depends on someone else paying more for it later? If it's the latter, you need to seriously think about reducing your exposure. Second, and this is the most critical step, is a total war on high-interest debt. In the environment we're heading into, debt is a cancer. It's a guaranteed claim on your future income, an income that might become uncertain. Credit card debt with interest rates of 20–30% is financial quicksand. It will drown you. Before you buy a single stock or an ounce of gold, every dollar you can spare should go to eliminating this debt. Being debt-free in a world drowning in debt is a superpower. Third, cash is king. In a downturn, cash gives you options. The goal right now should be to build a significant emergency fund of cash and cash equivalents, like short-term treasury bills. The old rule was 3 to 6 months of living expenses. In this environment, 6 to 12 months is far more prudent. This isn't your investment money. This is your survival and opportunity fund. It's what lets you pay your mortgage if you lose your job and lets you buy incredible assets at a discount when everyone else is forced to sell. Principle 2. Investing for the new reality. Once your fortress is secure, high-interest debt is gone, emergency fund is full, then you can think about a fence. But the investment game of the next 5 years will look nothing like the last 5. The first area to consider is hard assets. For thousands of years during times of crisis and currency debasement, gold and silver have served as a store of value. They are insurance against a systemic failure of government-printed money. The second area is productive assets with pricing power. What does that mean? It means businesses that are essential and can raise their prices to keep up with inflation without losing customers. Think about things people need, not just things they want. This includes sectors like energy, agriculture, and essential consumer goods. Look for companies with low debt and strong balance sheets. These are the cockroaches of the business world. They can survive anything. The third, more advanced idea is geographic diversification. If the United States is the epicenter of the storm, it may be smart to have some exposure to assets and currencies outside of the US dollar system. This is a complex strategy that requires careful research, but having all your eggs in one national basket is a major risk in itself. Principle 3. Building personal and professional resilience. The final piece of the puzzle isn't about money. It's about you. Your most valuable asset is your ability to earn an income, adapt, and handle pressure. First, stack your skills. The job market of 2026 and beyond will be brutal. We're already seeing AI cause major disruptions. The key to survival is to become indispensable. Continuously learn new skills that complement what you already do. In a world of layoffs, the last person to get cut is the one the company can't function without. Second, community and networks. In a crisis, your network is your net worth. Resilience is a team sport. This is the time to build strong bonds with your family, neighbors, and local community. Get to know the people around you. Build professional networks you can rely on for information, support, and opportunities. When the official systems start to crack, these human networks are what get people through. Finally, mental fortitude. Living through a period of intense economic change is incredibly stressful. The 24/7 news cycle is designed to keep you anxious. You have to protect your own mind. Limit your exposure to panic-driven media. Focus on what you can control: your spending, your skills, your health, your relationships. Acknowledge the risks without giving in to despair. The greatest opportunities are born from periods of maximum pessimism. Having a clear head when everyone else is panicking is the ultimate advantage. Let's pull it all together. We are facing a combination of threats unlike anything in living memory. The protectionist trade policies of the 1920s are back, creating an inflationary shock. The massive debt bubble of the 2000s has been reinflated to record levels, making the system incredibly fragile. And these historical problems are being amplified by new forces: a potential contraction of the government safety net, a stagflationary trap that has paralyzed the Federal Reserve, and a fragile global economy with no one to lead us out of the storm. This isn't fear-mongering. This is pattern recognition. The mainstream narrative will keep telling you that everything is fine, that a slowdown in GDP is just a soft landing. They are looking at the individual trees and refusing to see the forest fire. The combination of these factors is setting the stage for a crisis that could indeed be deeper and more disruptive than what we saw in 1929 or 2008. But being forewarned is being forearmed. The point of this video was not to scare you, but to prepare you. While many are being lulled into a false sense of security, you now see the real risks on the horizon. You have the blueprint to build your own financial arc, to strengthen your skills, and to fortify your mind. The pieces are moving on the board right now. The policies we've talked about are being implemented. The economic data is getting worse by the month. The question is no longer if a crisis is coming, but when and how bad it will be. Your job is to be ready. Make sure you are subscribed and click that notification bell because we will be tracking this situation every step of the way. Stay safe and stay prepared. Here is another video and a playlist, one step at a time.